Most people think of stock market crashes as rare events, but what if I told you there's a pattern that keeps repeating, and many investors still don't see it coming? The 1987 stock market crash was one of the most significant events in financial history, catching many off guard and reshaping the financial landscape forever. It was a wake-up call that exposed the vulnerabilities of the system and led to major reforms. Today, we're going to take a closer look at what happened, and explore the lessons we can learn from it. The crash of '87 was a global phenomenon, with markets plummeting worldwide. It was a crisis of confidence that spread like wildfire, and its impact was felt for years to come. Understanding what led up to it is crucial in grasping its significance and importance. In the years leading up to the crash, the stock market had experienced a remarkable bull run, with the Dow Jones Industrial Average more than doubling between 1982 and 1987. This created a sense of euphoria among investors, who were making money hand over fist. It seemed like the good times would never end, and many were convinced that the market would continue to rise indefinitely. Let's move on to the factors that led up to the crash. The economy was showing signs of weakness, with rising inflation and a growing trade deficit. The Federal Reserve, under Chairman Alan Greenspan, had been raising interest rates to combat inflation, which made borrowing more expensive and reduced consumer spending. Meanwhile, the dollar was weakening, and foreign investors were starting to lose confidence in the U.S. economy. In the months leading up to the crash, the stock market had become increasingly volatile, with large price swings becoming more frequent. This should have been a warning sign, but many investors were too caught up in the excitement of making quick profits to heed the warning. Technology was also playing a role, as program trading was becoming more popular. This automated trading strategy involved executing large trades based on certain market conditions, which could exacerbate market movements. It was a new and untested phenomenon, and many were unaware of its potential risks. By the summer of 1987, the market was starting to show signs of fatigue, with prices beginning to decline. It was as if the market was holding its breath, waiting for something to trigger a collapse. Investor sentiment was shifting, with many becoming increasingly nervous about the market's prospects. There was a sense of unease, but nobody knew exactly what was going to happen or when. Despite the warning signs, many investors were still caught off guard when the crash finally arrived. They had become too complacent, too confident in their ability to make money in the market. On the morning of October 19, 1987, the stock market opened sharply lower, with the Dow Jones plummeting over 200 points in the first hour of trading. This was not a normal market correction, it was a full-blown panic. As the day wore on, the selling intensified, with prices dropping precipitously. It was as if the market had lost all sense of reason, with investors frantically trying to get out of their positions. The trading floor was in chaos, with brokers shouting and waving their arms as they tried to process the onslaught of sell orders. It was a scene from a horror movie, with panic and fear gripping the hearts of everyone involved. The Federal Reserve and other financial authorities were caught off guard, struggling to respond to the crisis. They were like firefighters trying to put out a raging inferno, with the flames spreading faster than they could react. As the day drew to a close, the damage was staggering. The Dow Jones had fallen over 22%, its largest single-day decline in history. Over $500 billion in market value had been wiped out, leaving investors stunned and shell-shocked. The crash of '87 was not just a U.S. phenomenon, it was a global event that affected markets around the world. It was a harsh reminder of the interconnectedness of the financial system, and the speed at which panic can spread. In the aftermath of the crash, there was a sense of numbness, as if investors were still trying to process what had just happened. It was as if they had been punched in the gut, leaving them gasping for air. The crash led to a period of intense soul-searching, as investors and policymakers tried to understand what had gone wrong. There were recriminations and finger-pointing, as people tried to assign blame for the disaster. But amidst the chaos and confusion, there were also lessons being learned. The crash of '87 led to a major overhaul of the financial system, with new regulations and safeguards being introduced to prevent similar events in the future. The Securities and Exchange Commission introduced circuit breakers to limit market volatility, and the Federal Reserve established new procedures for responding to financial crises. In the end, The crash of '87 was a wake-up call, a harsh reminder of the dangers of complacency and the importance of vigilance in the markets. It was a painful lesson, but one that has helped shape the financial landscape into what it is today. So, what do you think about the 1987 stock market crash? Do you think we've learned enough from that event to avoid similar crashes in the future? Let us know in the comments below, and don't forget to check out our other videos for more financial history and analysis.